Why don't you tell us first off why BP is doing better than the rest, why you beat the street by so much?
Good quarter yet, $2.6 billion. I think the market was expecting something around about 2.1. If you looked on a pre-tax basis, we're in track with where the market was expecting, slightly ahead, stronger upstream, slightly weaker downstream, preferential tax rate in the fourth quarter. I think the main message coming through in the fourth quarter was strong operating cash flow of about $7.6 billion. That took it to $28.2 billion for the year. That's allowed debt to come down by over $1 billion in the fourth quarter versus the third quarter. Gearing's come down. And now we've announced the full $10 billion package of disposals. We've announced the further $5 billion today that we'll be doing out by mid-2021. All of that points towards a major deleverage of the balance sheet through the end of this year, and that's what's given the board confidence in moving the dividend this quarter.
OK, good morning to you, Brian. That's exactly where I wanted to go, and that's the questions around the dividend. So you say because of what you're doing to the balance sheet, that gives you the confidence to increase the dividend a little bit from 10.25 to 10.50. But the outlook for oil prices perhaps looks very uncertain with the coronavirus in China, such a big consumer of oil. What assumptions have you made about the strength of the global economy then to enable you to increase this dividend?
So we laid out a strategy in 2017 which takes us out to 2021 at $55 a barrel real was the number that we set that strategy and plan out, which is exactly where Brent is today. So we've seen the benefit of the higher oil price of sort of $60-65 range. If you look at this year, coming into this year, average demand over the last decade has been about 1.3 million barrels a day of oil growth each year over the last decade. Last year, we saw quite a bit of demand destruction, well below 900,000 barrels a day. Coming into this year, we saw demand growth of around 1.2 million barrels a day. And what you're seeing in terms of short-term impact to oil price is the effect of coronavirus, where the market, we think right now, coronavirus could have an impact of anywhere from 300,000 barrels a day to 500,000 barrels a day, which will soften demand up, and then I think all eyes then lead to OPEC as to whether OPEC will then look to rebalance the market to get back in the 60-65 range. But around $55 Brent today, that's pretty much the assumptions that we laid out to our 2021 strategy.
And you mentioned the gearing number has come down, but it's still above 31%, isn't it? Which is still higher than you want it to be. It
is, but I think the big message there is of the $10 billion package of disposals we said we'd do over 19 and 20, only about $2.8 billion of proceeds came in last year. The balance of proceeds will arrive this year, and along with a further $5 billion package out to mid-2021, that gives us the extra cushion to see the deleverage come through this year.
Clearly, the coronavirus effect wouldn't have been visible in the last quarter's earnings. But what are you seeing right now, Brian? Because it strikes me that with this amount of people quarantined with this much travel canceled, it must lower demand substantially for gas and oil.
So right now we're seeing around about 300,000 to 500,000 barrels a day demand destruction off the back of coronavirus. It looks very similar to what we saw back in 2003 with SARS, where we saw something around the similar sort of levels. We'll see how this plays out. Well, the biggest impact you're seeing is in terms of Brent flat price today in terms of crude prices. We aren't seeing any impact in terms of overall demand right now in terms of our own system and our own fuels networks, but clearly there'll be some impact in terms of aviation and aviation travel, which is what you'd anticipate. So right now we're seeing something around 300 to 500,000 barrels a day of demand destruction set against growth that we were seeing come into this year of about 1.2.
How do you expect that to hit your trading and trading profits? Because you had a strong trading profits in 2019, and I wonder also if you could quantify what you mean by that. Repsol said I think it was the best results in recent memory, or Shell said it was the best results in recent memory. Was it that good for you too?
Yeah, I mean, for our trading business, volatility is kind of crucial in terms of how we structure that business and how we trade, both in oil and in terms of gas. Just to put it in context, 2019 is probably one of the strongest years that we've seen in both our oil trading and our gas trading in the last decade. And you've seen that come through the results, particularly in the upstream in the fourth quarter, but also across the year in terms of the downstream.
Let me ask you a little bit more about the dividend and the sustainability of that then, Brian. I mean, clearly the conversation around oil companies is moving very quickly and their commitments to climate change and the like. Can you maintain this kind of dividend? What is the trajectory for the dividend as you have to invest in new technology?
So what we've said around our dividend is a progressive dividend policy. If we move it up, it has to be sustainable going forward, which is what we've laid out today with today's results. 2021, which is a big series of targets that we're focused on in terms of delivery, would see surplus free cash of the tune of about $5 to $6 billion set against an $8 billion dividend in terms of full dividend. That is comfortably manageable within today's financial frame. The energy transition that we talk about and the requirement for big investments in new technologies in terms of dealing with CO2 will be crucially important. We will manage that within our existing financial frame. So we are very confident that today's dividend is sustainable in today's frame.
I wonder if you take a longer term look at the transition, does it strike you that it's going to happen sooner than we may have thought? You know, Repsol said it's going to get away from all fossil fuel burning or all CO2 emissions by 2050. A lot of countries are saying no more gas or diesel cars by 2040, some even 2035, which is sooner than Germany even plans to phase out coal. Is this all happening at a quicker pace or planned at a quicker pace in the last few months, last year?
Yeah, look, I mean, I think first of all you have to start with where the base position is. Today we consume, the energy demand is about 85% of energy demand is linked to oil, gas and coal. 4% is renewables, 4% is nuclear and 7% hydro. We've got 2 billion more people on the planet over the next 20 years that will require a 30% increase in demand for energy. So it's going to be a transition that will be over multi-decades. The crucial part for companies like ours and for the sector is to start to, first of all, continue to grow renewables at as fast a pace as we can economically, and then look to deal with the CO2 associated with the production that we produce. And if you look at what we laid out off the back of Paris in 2015, we said we'd look to reduce our own CO2 emissions by 3.5 million tonnes by 2025. We may well have hit that target already by the end of 2019, and we'll certainly be close to it, having taken out 2.5 million tonnes by the end of 2018. So I think we have to progress.
Will you join Repsol, Brian? Would you come out and say we'll get rid of CO2 emissions completely ourselves at the company and our customers by 2050?
We have to look at this across the suite of our products and look at what we can do in terms of technology, what the technologies are available to us. We've got our first big CCUS that we're looking at up in the northern part of England around dealing with CO2 off the back of an investment there. And we'll continue to look at that across the suite of things. The key, what we laid out a year ago, 2 years ago, was around we'll look to reduce our emissions, improve our products for our customers, and then create low carbon opportunities. And we'll continue to do that as we lay out our strategy out to 2025.
Brian, just briefly, is the investment community putting pressure on you in this front? Have conversations with the investment community, with shareholders, changed in the last 12 months or so? Oh,
absolutely. And I'd say over the last 5 years, if you come into a conversation with investors 5 years ago, ESG as a sort of a catch-all, but really for companies like our own, it's really about climate, is the big area for discussion. 5 years ago, that wasn't really on the radar screen. That's come up certainly over the last 18 months, 2 years, and is front and centre in everything we do. It's part of our compensation today. That was put in place a year ago. It will be part of our compensation going forward. And I think investors genuinely, as do we, want to find a solution to this issue that's facing the climate.